Welcome to the Deep Dive. You sent over the ServisFirst Bankshares Q2 2025 earnings call, and yeah, there was definitely some buzz around their results.
That's right.
So today, we're putting on our TalkTickers hats, really digging into what happened and why the market reacted the way it did.
Exactly. It's about unpacking the numbers and, maybe more importantly, the strategy behind them.
Okay, let's start with the headline figures. Give us the quick snapshot.
Sure. So adjusted EPS, earnings per share, came in at $1.21.
Right on the money with estimates, wasn't it?
Bang on consensus. And pretty impressive growth, too, up 27% year over year.
That's a solid number. What about revenue?
Revenue was $132.1 million. Now, that was actually a slight miss versus the street's expectation of around $140 million.
A miss there, but still growing year over year.
Oh, yeah. Still up a healthy 15.1% compared to Q2 last year. So growth is definitely there, even with the miss.
Gotcha. Now, the big one for banks' net interest margin? NM. That looked like a real highlight.
Absolutely. NM expanded quite nicely to 3.10%.
And that's up from, what, 2.92% last quarter?
Exactly. And up from 2.79% a year ago. So a really positive trend on the margin front.
What was driving that? Was it funding costs?
Yeah, that was a big piece of it. Their average cost for interest-bearing deposits actually came down slightly.
Oh, interesting. Down how much?
Down to 3.33% from 3.40% in Q1. So, not a huge drop, but definitely moving in the right direction, easing funding pressure.
Okay. And loans. Did they keep lending?
They did. Loan balances grew by about $346 million in the quarter.
Which translates to?
Year over year, that's 7.3% growth. Their total loan book is now sitting at $13.23 billion. Pretty solid.
And what about the other side of the balance sheet deposits? I saw those were down sequentially.
They were, yeah. Ending deposits decreased by $567 million compared to Q1, landing at $13.86 billion.
Any cause for concern there?
Well, context is important. They were still up 4.5% year over year, and management actually framed this as more of a strategic move.
Strategic? How so?
Basically letting some higher cost, more temporary deposits run off to improve the funding mix. We can dig into that more.
Okay, definitely want to circle back to that. And quickly, credit quality. Always crucial.
Right. So non-performing assets, NPAs, as a percentage of assets, ticked up just a tiny bit, 0.42% from 0.40%.
Okay, a small move. How did management sound about that?
Cautious, but, controlled. Net charge-offs were manageable at 0.20% annualized.
And their loss reserves, the ACL.
The allowance for credit losses held steady at 1.28% of loans. So they seem comfortable with their current provisioning levels.
And one last snapshot, number of book value.
Grew nicely, up 14% year over year to $31.52 per share. A good sign of underlying value creation.
Okay, solid overview. Those numbers paint a decent picture, but let's get into the why behind them. That NIM expansion to 3.1% is really striking. What was the main engine there?
Well, it wasn't just one thing, which is often the case. It was partly easing deposit costs, like we mentioned, but also some very deliberate actions they took.
Okay, like what?
Well, first, there was a bit of a, let's call it one-time assist. They had a reversal of an interest expense accrual related to a legal matter.
Ah, okay.
Yeah.
How much did that help the numbers?
It lowered their Q2 deposit cost by about 7 basis points. So a noticeable bump, but management was really clear, don't expect that specific benefit again.
Okay. Good to strip that out mentally. So excluding that one-off, where do they see deposit costs settling?
They guided towards costs normalizing closer to where they were in Q1, so around that 3.57% mark in the coming quarters.
Got it. So still some underlying improvement, but that 3.33% number had a temporary helper. What else drove the N9?
The other big piece was a strategic move in their securities portfolio. They took a bit of medicine, basically.
Medicine, how so?
They sold about $70 million worth of bonds that were yielding, get this, only 1.34%.
Wow. Yeah, that's low in this environment. Did they take a loss on that sale?
They did, an $8.6 million pre-tax loss. But here's the key part. They took the proceeds, about $62 million, and reinvested them into new securities yielding an average of 6.28%.
Okay, now that's a significant yield pickup, like swapping out an old clunker for a sports car, engine-wise.
Exactly. It's a classic portfolio restructuring. Hurts a bit now, but the payback period is estimated at just under 4 years, and it should really boost their future earnings power and NIM from here. Very proactive management.
That makes sense. Okay, let's shift to loans and deposits. You mentioned strong overall loan growth, but management called demand Good, not great. What's the story there?
Yeah, that 11% annualized growth net of payoffs is definitely strong. Their pipelines in C&I, commercial and industrial, and also in CRE look pretty robust.
So why the good, not great comment then?
It seems to be mostly about headwinds on the commercial real estate side. They highlighted elevated payoffs there.
Meaning existing loans are getting paid off faster.
Right. And also they noted that a lot of new CRE projects just aren't penciling out for developers at today's higher interest rates. So originating new CRE loans is tougher.
So are they pivoting away from CRE?
Not entirely, but they are definitely emphasizing C&I lending more strategically. It seems to face fewer of those payoff headwinds right now. It's about being nimble, focusing where the better risk-adjusted opportunities are.
Makes sense. And back to that deposit decline sequentially. You said it was strategic. Unpack that a bit.
Yeah, it wasn't like depositors were fleeing. It was more about letting certain types of deposits run off intentionally.
Which types?
Higher cost municipal deposits and some correspondent banking funds. They specifically mentioned one large municipal deposit tied to a construction project that's now underway. So those funds were expected to flow out.
So they were essentially shedding some excess higher cost funding that was dragging on their margin.
Precisely. It was a deliberate move to optimize the funding base. Their real focus now is on attracting core operating accounts, sticky business deposits often linked with their treasury management services. Those tend to be lower cost and more stable.
Okay, that context helps understand the deposit move. Let's talk risk credit quality. That small uptick in NPAs, non-performing assets. Should investors be worried?
Well, management seemed pretty calm about it. They were quick to point out it wasn't a broad trend.
So isolated incidents.
Exactly. They said the increase was concentrated in just 2 specific real estate secured loans. They did a deep dive into the portfolio and specifically stated they found no systemic issues or wider negative trends brewing.
Okay, that's reassuring. What about actual losses, the charge-offs?
Total charge-offs were about $6.5 million. The main driver there was actually one specific loan that deteriorated unexpectedly, accounting for about $5 million of that.
Ouch, one loan causing most of it.
Yeah, that happens sometimes. Because of that and the general loan growth, they did increase their provision for credit losses to $11.4 million for the quarter.
But their overall reserve level, the ACL ratio, stayed flat.
Correct. Stayed stable at 1.28% of loans. Suggests they feel adequately reserved. And they also highlighted they're actively working through problem loans, resolved a couple of older ones, and expect more resolutions later this year. So they're not just waiting around.
Sounds like active management for sure. Okay, shifting gears slightly. How are they managing costs while also trying to grow non-interest income? What's their efficiency looking like?
Impressively lean, actually. Their adjusted efficiency ratio held steady at just under 32%, 31.94% to be exact.
Wow, that's quite low. So tight cost control.
Very much so. And that's even while they're investing in some new areas. They expect non-interest expenses to stay in a pretty tight range, around $46 to $46.5 million per quarter.
So what are these new growth initiatives? I think you mentioned merchant services earlier.
Yeah, that's one they seem quite optimistic about. Even if it's starting small, they've hired 7 new producers for a new merchant services group.
What's the opportunity there?
They see a big chance to cross-sell these services to their existing business clients. Apparently, their penetration is only around 1% right now.
Only 1%, wow.
Yeah, and they think they can realistically get that up towards maybe 8%. It won't transform the bank overnight, but management called it a nice little kick to non-interest income, leveraging existing relationships.
Smart. Any other non-interest income levers they're pulling?
Yes, actually. Treasury management fees affect July 1st, so it didn't impact Q2. They increased service charges related to treasury management.
Okay. Significant increases.
Well, what's really interesting is they said this is the first time they'd raised these particular fees in 20 years.
20 years. Wow. That suggests they feel they have some pricing power there.
It certainly does. They expect this to boost non-interest income and maybe even attract more non-interest-bearing deposits over time.
Oh, one more thing on efficiency. They changed their core processing system.
They did. Switched to a direct relationship with Jack Henry, moving away from a third-party setup they had before. That's expected to generate some cost savings down the line, too, helping keep that efficiency ratio low.
Okay, so lots of moving parts, but generally positive execution. Putting it all together, what's the outlook? How's management feeling?
They use the phrase constructively bullish, especially on the net interest margin.
Constructively bullish. Okay.
Yeah.
What does that translate to in terms of numbers?
They think NIM can keep climbing, maybe by another 10 to 14 basis points per quarter through the end of the year.
Wow, per quarter. So potentially hitting?
Potentially reaching the 3.2% to 3.25% range by year end. That's assuming the Fed doesn't make any more moves, of course.
And what if the Fed does cut rates?
Well, they noted they're slightly liability sensitive, so a Fed cut would actually accelerate that margin improvement. That's a nice position to be in.
Interesting. And just to confirm, those deposit costs are expected to tick back up a bit from Q2's artificially low number.
Yes, they expect them to normalize back around that Q1 level, roughly 3.57%, now that the one-time legal accrual benefit is gone. That normalization is already baked into their margin outlook.
How does ServisFirst stack up against the broader regional banking landscape right now? Are others seeing similar trends?
Well, generally, many regional banks are seeing deposit costs moderate, which is helpful. Funding pressures have eased somewhat across the board.
But the CRE headwinds are still a factor for everyone.
Absolutely. That's a common theme navigating those commercial real estate payoffs and the slower origination environment. What seems to differentiate ServisFirst, based on this call, is their proactive management of it. The C&I focus, the securities restructuring, the deposit optimization, they aren't just riding the wave.
And it looks like the market is noticing that difference. Their stock performance has been pretty strong relative to peers lately, hasn't it?
Yeah, SFBS has definitely outperformed benchmarks like the KRE Regional Bank ETF and even the broader XLF Financial Sector ETF over the last 1 and 3 months. Significant outperformance, actually.
So investors seem to be buying into their specific story.
It looks that way. The market seems to appreciate the execution, the margin trajectory, the cost control. Key things to watch going forward are definitely continued M expansion, loan growth holding up, and seeing that yield pickup from the bond portfolio materialize.
And the risks. What should people keep an eye on?
The main risks would be if deposit competition heats up again unexpectedly, pushing costs higher, or if credit quality deteriorates faster than anticipated, leading to higher charge-offs. Standard banking risks, but worth monitoring.
All right. Now let's pivot to our favorite segment, the not financial advice segment, trade ideas. Remember, folks, these are just thought experiments, applying what we learned to some potential, maybe slightly out there strategies.
Exactly. Purely hypothetical, designed to get you thinking. Okay. Pitch number 1 for the Imaginary Investment Committee. Long SFBS, short a CRE-heavy regional bank ETF. The idea here is simple. Bet on ServisFirst's specific strengths while hedging out some of the broader sector risks they seem to be navigating better than others.
Okay, unpack that. Why long SFBS?
Because of everything we discussed. Their strong C&I focus, disciplined cost management on both deposits and operations, and that proactive securities restructuring boosting future in. They seem to be executing well.
And why short the ETF?
You'd pick an ETF with significant exposure to regional banks that are maybe more reliant on commercial real estate, which faces those payoff and origination headwinds SFBS is actively managing. Shorting that hedges against broader CRE macro risks. You're isolating SFBS's perceived operational alpha.
So betting on relative performance. Interesting. Okay, what's pitch number 2?
This one's a bit more conservative, maybe for someone who already likes or owns the stock. Use a covered call strategy on SFBS.
All right, explain that. Selling calls against your stock position.
Precisely. The stock has had a decent run post-earnings. Management sounds positive but cautious, constructively bullish. So you could sell out-of-the-money call options, say 5-7% above the current price, maybe 30-60 days out.
And the benefit is?
You collect the premium income from selling those calls right now. It enhances your overall yield on the stock. It also provides a little bit of a cushion if the stock pulls back moderately. You're essentially getting paid to wait for that NIM expansion and other initiatives to fully kick in while expressing a cautiously optimistic view.
So generating income while potentially limiting some upside if the stock reps higher, but adding yield and a bit of protection. Makes sense. 2 very different ways to play the situation. Okay, let's wrap this up. To recap our deep dive, ServisFirst bank shares put up a solid quarter. Strong adjusted EPS, that impressive NIM expansion was key, even with that one-off boost, and loan growth kept chugging along.
Yeah, and those strategic moves, restructuring the bonds, focusing on C&I, optimizing deposits, pushing into merchant services, they really paint a picture of proactive management aiming for sustainable profitability.
And despite that slight headline revenue miss, the market clearly liked what it saw, suggesting confidence in their ability to navigate the environment and execute on that margin expansion plan.
Definitely seems that way. The outperformance speaks volumes.
So here's a final thought to leave you with. As banks like ServisFirst navigate today's challenges with specific strategies, what other innovations, maybe in how they gather deposits or generate non-interest fees, might we see emerge that truly separate the long-term winners in this regional banking space? Something to keep thinking about. And please remember, everything we've discussed here on the Deep Dive is strictly for informational purposes. It is absolutely not financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
That's right. Do your own homework.
We'd love to hear your thoughts on the ServisFirst call too. Find us on social media and share your questions or insights. Thanks for tuning in.